Well, again, everyone, and welcome to the Options Mentor. And we've just finished another week with a run up in the S&P as we head into this holiday weekend. Monday, of course, the market is closed. We have the presidential inauguration also. And then a week ahead, at least with planned economic news, it's kind of light until Friday. We get a PMI, which could have some significance because it is, of course, an inflation number, and the market really looks at those hard because of what the Fed might think. So today I want to talk to you guys a little bit about butterflies and show you even a butterfly strategy that I think makes sense in this market currently. Now, for a long time, those of you who have known me, I've been very much into butterflies. I did them for years as my main trade. But I found over the last year, even year and a half, that they just didn't provide the room that you needed in a trade. They were too narrow now, and then there was widening them, but there came a point, I'm going to go through this, where you just couldn't get them wide enough. And I think part of the reason is the market has ran up so far, even a small percentage move, say a 1% move in the SPX is 60 points now. I mean, even more small moves are big just because of the size now and of the SPX and how far up it has came. So let me share my desktop here, and we're going to get to talking about butterflies. So we can see here we're running up here. I do think, we got resistance here at the all-time high, of course. Are we going to get there this time? We might. But I think things will probably slow down, I would imagine, even between these two for now, between where we're at now and the all-time high, that is. So back over to the butterfly. I remember back years ago doing butterflies a lot that were 60 points up, 50 points up and 60 points down. Very narrow flies. And they did work for a long time. We were in a lower volatility market, less price movement, and we didn't have all the things that have driven this market so high. I mean, the market's been really going up about 16 years now, but the last couple of years, you guys know, it's really exponential. So then I just got to where, okay, let's get wider. So let me just show you an example. Maybe you go up 60, down 70 from the center. And the center usually is around where we're trading. By the way, we closed at 59.96. So I just used 6,000. And that wasn't working, right? We needed too much room. If you think about it, let's just look over here. By this coming Friday, the 24th, the expected moves 80, almost $90. Well, this is not going to contain that. Not even close if that actually happens. So then I even went up as high as going up 80 and down 90. In fact, I think I've done it even 10 more points before, but it's been a while. But and the problem is these start to really get expensive. And whenever you get to the edges, you're usually down a little bit more. So it got to be where I found, the double diagonals that I've shown you guys, and those were able to cover this distance much better. And even those, say probably most of the time, needed to be adjusted, and they gave you a lot more room than this thing does. So I just shied away from flies almost totally for the last year. But there is, there's one more thing I want to show you here. Let's just say you're doing a more standard fly, probably at the moment, which would be like up 70, down 80. Like I said, doesn't provide you enough room. And you can see here that I've gone out over 3 weeks. You can go out as far as you want. I really like going out 35, 40 days. But at the very least, I want to be out 3 weeks. And the reason is this. Let's look here. If I'm here on the 14th of February, which is like 26 days out, you're down 62 on the upside and you're down 16 on the downside. If we get there, what if I did this for, say, the 31st? I'm down 47 and I'm down $140, $130 on the upside. So what happens is, yes, if you do a shorter term fly, you get better time decay, but there is a danger to it. And that is that if it does get in trouble, it gets in trouble quicker on the edges. That's why I find it's much safer to go out over 3 weeks or right at 3 weeks with your trades. I want to make clear something. Sometimes people hear 3 weeks and they go, oh my God, I'm not sitting in a trade for 3 weeks. Well, you're not going to be sitting in it for 3 weeks. Most of the time you can be out of these trades, even butterfly trades that you might put on 3 weeks out. You'd probably be out of them in a week. I've been out of them in less than that. Yes, if you have to start adjusting them a lot of movement, you might be in it longer, but it doesn't mean just because the trade's over 3 weeks out that you'll naturally most of the time be in it over 3 weeks, because you won't. We're not waiting for expiration day. We're just trying to get 8 or 10% profit and get out. And that should happen well before you're in it that amount of time. And then another benefit you get though from this is it's very peaceful. If you do need to adjust it, you'll be down very little when you do. Um, so big movements, hey, you get up tomorrow, we're down 100. You're really not in that horrific a shape. It's not pleasant, but it's not terrible shape. Same thing with up. So when you're further out in time, the damage will be a lot less if the trade gets into trouble. That's why I like to be out that far. But that brings me around to the fact that I'd mentioned earlier that butterflies just haven't given you the room. So one thing you can do, and I'm going to talk about this today, and I think even this strategy makes sense in the current market. I've shown it to you guys before, and that's the double butterfly. The reason I would want to do it is I get even more room. You can see here, even with the 70 up, 80 down, I've got about 70 points down and about 60, 70 points up. And after that, I'm going to have to adjust. So what if I do something like this? What if I put on a call fly and I'm just going to work through the numbers? It could be less, it could be more. But what if I go up over 40 points, just over 40, and center a call fly? And even if I do it, even not as wide, say 60 up, 70 down. Let's look at that. So we'll go, that's 60 up, and now we'll go 70 down, which will be 59, 70, I believe, right? Yeah. 70 down, 60 up. There is our call fly. Matter of fact, I think we probably, let's just take this up 10 more points just to show you the width you can get with this. So we're up a little over 50 points. And then still the same numbers, with the down and up, still 60 up, 70 down. So that's the call side. Then you could go and put on a put fly here below it. Now you could do calls. Sometimes when I do double flies, I like to have 1B calls and 1B puts, just because it's less confusing when you look at these strikes in your account. Sometimes you can get them confused with what goes with what trade. I mean, yes, you can group them together, but it is much easier just to have one set of calls and one set of puts. So let's see if we can do that same thing. Maybe we'll go down 50 points or so. Let me go down to 59.40, up 60, of course, would be 6,000, down 70, which would be 58.70. Okay, that probably did something right. 14.10, that's not right. 59.40, up 60. Oh, this should be 58 by mistake. This is why I like this screen. You can always just work through things before you ever put a trade on to make sure that you've got everything right. Then you can send the trades in to be filled. It just helps me a lot visually to be able to see this. Same when I do adjustments or anything I'm going to do. I like to look at a trade before I do it and how it will look. And this is why I really like the Thinkorswim screen here now at Schwab. So here it is. One of the rules I like to follow is I really would prefer, in butterflies even, that the two complexes where they connect is above the zero line. You can see that. However, you could be a little below, maybe 7-8% even below, and it can still work. But that is about as much as I'd want to be. I don't want to dip much below this line at all. I'll go a little bit, but not much. But look what happens when I tick time forward. This is this time decay. You can see that in these trades, the reason why I'm comfortable with this dip, even below zero, is you can see the daily line or where you'd actually be if you were here in the future here. If we were here on the 5th, we can actually be up more money than we would be if it was expiration. So since this is true, and I've done it many times and it is true, I I'm willing to have these just above zero or just below zero where they connect with each other. Now, the only benefit to doing all this, of course, is that you want to have a lot of room in your tray. That's really the idea here. We want lots of room in our tray. So now from the center, I have 100 points up before I really be at my break even, or 100 points down. So that's a lot better than that 60 points or so I showed you with the other one, isn't it? Now, it's a little expense to it. I mean, it's $14, not bad, cheaper than that other one we were looking at. Remember, it was 19, I believe, for like this 70 up, 80 down. And then the put one is less expensive also on the debit, but the reason is because there's margin. See this margin of 980 bucks. You'd add that to this, and that would be like a little over 1,200 bucks, right? A little over $1,200 for the put fly and $1,400 for the call fly. And like I said, the smaller debits, just because for whatever reason brokerages count unbalanced, which this is because it is, what is it, 60 up, 70 down. Because they're unbalanced for whatever reason, more brokerages call put asymmetrical flies like that. They see it as a debit and a credit vertical. They don't deal with calls, only with puts. And you can see here, for instance, if I just change this to calls, now everything's right here, isn't it? Everything is in the debit, no margin. But if you do it with puts, you just got that margin and a small debit. That is part of your trade. Just add the two together, plus the other call. That's your cost of trade. So whatever the call fly costs you, whatever the put fly costs you, debit plus margin, put all that together, that's your cost of trade. Well, let's just say it's around $3,000. Want to get around 10% or around 300 bucks, maybe take a little less. That's the concept. And you have a lot of room for this to roam. Now, why do I like these a little better here? Well, I like flies best, not the only time, but I like flies in general best when the VIX is between 15 and 20, where we're at. And with where the market is now, here near all-time highs, like I said, even a small percentage is a lot of movement. 1% play here is 60 points, and you wouldn't have anything to worry about in this. So I think a trade like this makes sense. And it is short Vega. So if volatility went down, it could help it some, or if it went up, might hurt it a little. But I have found that butterflies ultimately seem to be less affected by volatility changes in their favor or against them than, say, a long Vega trade like a calendar. My goodness, it is profound if the volatility works for you or against you. It can really mess your trade up bad if volatility drops on you in a calendar, and can really help you if it goes up. That's why I'm pretty particular about when I put on new calendars. I really want that VIX below 15, lower end of the range, really like it in the 13s and under. But a butterfly, I've come to find over my 20 years now of trading this style, it's really a movement-based trade. Whether you're going to make money in this or not is more about movement than volatility, because that's what's going to tell the tale ultimately. Is, did you stay inside your graph? Were you able to adjust to stay inside this expiration graph? Those are the things that make butterflies what they are. So I like this trade. I think it makes a lot of sense. And I would try to put it on if the market hasn't changed a lot. I might even look at something like this on Tuesday. Remember, the market's closed tomorrow. This is Sunday, but the market's closed on Monday. And so this might be something I'd look at Tuesday unless things have changed drastically. Hey, if we come into Tuesday and the VIX is spiked up over 20 or something, I'll hold on, or if we're, up or down 100, something happens that makes the market super happy or very riled, then that wouldn't be true. But if we kind of coast in here with the similar volatility levels on Tuesday, this would be the type of trade, or one of the types of trades I might look at. Now, as always, if you're not used to, if you've never done these trades or any of that, you should be trading on paper. No one should do these trades live before you've experienced them on paper and understand them. Know why you put it on the way you did, what your profit goal is, what am I going to do if it goes against me? If you don't know those answers in an exact form, exactly when and how I'm going to do something for or against me, then you shouldn't be putting on a trade with real money. So you need to understand that the best equip yourself. And of course, it has to make sense in your overall financial life, if you're doing options. But if you're doing options, you understand them, something like this makes sense for you, you've paid your trade, it looks good, and you've done well with that. I think making a small foray into it could be an idea for you, perhaps. And I'd always start small, one lots, work your way up from there if you ever want to do these. Don't, just because you have the money in your account, don't do 10 lots. Do one lots. If you had a $500,000 in your account, do a one lot of this whenever you do decide to go live, because you're still going to have some hiccups and learning along the way when you start doing these. And it's no sense in paying extra money by losing in a big way whenever you could do small bets. Maybe your first few flies will be rough for you as you're getting your option trading legs under you. You might lose a little bit, but if this was a 10 lot, you're going to lose a lot more. So there's no point in doing that. Start small. You get a couple of these working for you, and then maybe go up in size, a contract or something, that type of thing, and then head on up as you have successes, if that makes sense for you. As always, I'm very willing to help you with one-on-one mentoring or coaching every day over at airmer.com. All the links for that, my emails for the mentoring, it's in the description of this video. And of course, all the links for my courses at Airmer and my daily meetings over at airmer.com. All there. I wish you'd come over and join us there. So many people have off this YouTube channel. I really appreciate that, because you get a more dialed in management, the whole management of a trade, whenever you go over there and do that or take one-on-one mentoring. So that's what I have for you guys this week. Please hit the like and subscribe button. I appreciate all of you. I hope you have a good 3 days off from the market and an excellent trading week. I'll be back here with you next week for another edition of the Options Mentor. Everybody have a great one. Bye-bye.